Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you a clickbait investor, a trader? And when you buy and sell securities, should you do that in pieces, in parcels, or should you just go all in and all out at once? We'll talk about that later in the show because that's very important, especially if you're managing your own money. By the way, that's the name of our show, Your Money. But first, let's go to the show notes. There's a few articles in there. You can go read them. I'm not going to get into them, but Vanguard, the Vanguard split, big behemoth Vanguard is splitting, and that may mean that the cheap way to lose money fast in a bear market may have just gotten more expensive for the privilege to lose money fast in a bear market. I guess you get what you pay for, or don't pay for. Okay. Listen to our podcast just a few weeks ago on fees, low fees versus cost benefit. It's a very good informative show. Anyway, and Social Security, are politicians going to steal your money? Again, that's the name of our podcast. They're talking about, so the Cato Institute issued a new study to save Social Security. We need to give flat benefits. We're just going to do $1,600 to $1,800, everybody across the board. So everybody kind of gets, it doesn't matter how much you paid in, if you put in more or not, we're just going to do a flat benefit for everybody. Make it simple. Wow. Now, that's an interesting article. But how does that help you make money on your money? And by the way, if the politicians let us do it like Australia, and we withhold an automatic 7.5%. If you do the company match, it's 15%. We're a huge saver. If we could invest it like Australia, their annuation fund, they automatically have to withhold 9%, but they get to invest it how they want. So their balances are much larger. So anyway, but Social Security is going bankrupt. That is the clickbait for you Bitcoin bugs and gold bugs. By the way, I'm not saying I'm not one of those or both, right? But it's got to be confirmed by price. But the bankruptcy, the debt, tariffs, the Israelis, all the conflicts, that's all clickbait, right? Also, the feast or famine. The Golden Cross, the Death Cross, it's feast or famine for the stock nerds. It's all about making you fearful or, greed or fear. And but it's headlines. We at Revere, we don't manage money based on headlines, politics, stories, the stock tip, the whisper number. Oh, it's the whisper number on Wall Street. You got to know it to be on the inside. And the rumors, folks, a lot of times the upper management put out these trial balloons just to see how it'll go, and they haven't even made a decision yet, and they see how the suckers react. Sometimes you're the fodder. Don't be the fodder. Anyway, so again, I ask you, are you the clickbait? If you are, as Scooby-Doo would say, rut-row. Again, rut-row, rut-row. Or worse, not even being emotional by the clickbait, are you being misled by the big players with their agenda? The pie charts are us pushers. Kind of like the drug pushers. Did I say that out loud? Okay, folks, that's why at Revere, price is truth, no exceptions. Price is truth, no exceptions. So if you're investment challenged, we can show you a better way. We've got I guess the best way to call it is a 12-step recovery portfolio plan. We got rules. We got all these things in place from the entire portfolio down to every single security in the portfolio. So at Revere, every investment must earn its way on our portfolio, and then they must continue to earn our ways on our portfolio. And more importantly, your money looks just like our money. down to the same price and timestamp and percentage of position in the portfolio. We do all of our trading at block trades. We're not doing individual accounts at your level. It's all about the risk in the market, the sector, the stock itself, not as much about your risk tolerance. Let me ask you, even if you tell me you're super aggressive, should I hold a crashing stock because you told me you're aggressive? At Revere, we don't hold crashing stocks because we think it's dumb to hold a crashing stock. What say you? Anyway, at Revere, price is truth, no exceptions. Okay? So we're going to go to the team in a minute, and we're going to find out what's earned its way onto our portfolio and what has continued to earn its way on our portfolio and what has gotten kicked off. Okay? Now, just as a reminder, because we always talk about the portfolio stuff, we're a full wealth management firm. We got Todd here. He got a CPA background, a CFP. I've got all the background stuff. We can do complex estate planning, all that stuff. We just don't talk about it that much because, let's be honest, it's boring. Nobody wants to talk about their wills, trust, or estates, revocable trust, but we're well heeled in all of those. Anyway, and also before I forget, the upcoming July 4th, this next week, we are taking a break from this podcast. I'm giving the team a break for a job very well done. By the way, we're at all-time highs at Revere. The market is all-time highs, and so are we, but we're just not pie chart growing. We actually grew faster than the market. We're growing because of money coming in, not just the growth of our portfolios organically. Okay, now, before I go to the job well done team Revere, I'm going to go to the mailbag very quickly because we got a couple very good mailbags that highlight kind of what we do. And by the way, if you've got any questions or comments, you go to revereasset.com. Up in there's a contact us button up there. It'll send me an email directly, and you can just say, hey, give me a complimentary portfolio review, and we'll contact you and reach out, leave your contact. Or if you want a topic or a stock talked about on the show, you can ask. So in any event, before I go any further, 622 BP. Don, I always use your nightly wrap-up to confirm or deny my market hypothesis, since our hypothesis and guidelines are both based on Juan, William O'Neill, principles. You do our Juan community a great service while providing young associates at Revere a progressive opportunity in their careers. Both true. Can I add some suggestions? Please consider adding running total number of distribution days to the tail of the tape, considering that a follow-through days are cited. Follow-through days are one side of the risk-reward sentiment entering, and distribution days are on the other side of risk-reward exiting. Distribution days means heavy selling. Follow-through days mean heavy buying. So institutional buying versus institutional selling, they measure that at IBD. Anyway, so Don, hi B, thanks for following and reaching out. In my view, distribution days are not as crucial to track due to dirty volume. The team will explain that a little bit later. Don't let me forget. Dirty volume and varying degrees of losses. We place more emphasis on other secondary indicators. Remember, price and volume are always primary. Price and all the technical indicators feed out of at least price and or volume. Okay. Anyway, by the way, even, and this is just a side note, even IBD's own Ken Shreve agrees with Don and didn't think these particular distribution days were a big enough magnitude. And there's an article in IBD. If you got the paid subscription to IBD, you can go read that. All right. This is actually another question about an incoming client. I'm pretty sure he's coming on board. He's, vetting us, whatever. And so he's doing our paperwork, onboarding paper. He's asking a question. At Revere, we try to be we're the most transparent advisor I'm aware of. We're putting out more content anywhere on the planet that I know of. These guys put out stuff every day for free for you stock nerds. Anyway, 624 JV. Question number 1. The question I have is about the same section of the agreement 5. The last sentence says, I'll be responsible for reimbursement to the advisor where a cost was incurred on my behalf, and am curious, what would be an example of this kind of cost? And 2, if ever, how often have your clients been asked to reimburse advisors? That's a great question. Boilerplate disclosures. Anyway, The only other question would have also been a good one for Dan, but the CRS says the way we make money creates some conflicts of interest, and to ask you about them. It sounds like more legal CYA jargon. He's right. But since the resource suggests I ask you guys how much your conflicts of interest affect me and how will you address them, I feel I should ask. My answer. Thank you for asking. First, never has a client had to reimburse Revere, and up till now, I don't know of any situation that they will. We're fiduciary, manage clients on clients' behalf. We're not brokers. We're not working on commissions. There's nothing. I mean, it's not very common. Anyway, now two. The answer to number two is these conflicts of interest. I said I do have my life insurance license. I've had it for decades. I rarely use it, and only for cheap term. That's actually when clients beg me to get it for them. I try to send them to an agent, but they want to use me because they trust me. I said, I have done probably 3 policies, term policies, in 5 years. No big commission, surrender penalty products. I actually keep it to argue with insurance companies who sell crappy annuities sold to unsuspecting victims. And I try to get them to waive the surrender penalty and surrender the annuity a lot of times. Anyway, also, theoretically, we could take lots of risk. If we get paid on a management fee, we could take undue risk to try to build up our fees, okay? Risk to make lots of money, therefore increasing our fees, but it can also lead to potential losses, taking undue risk against clients' interest, against their risk tolerance. The answer is our track record, with 1/3 the drawdowns consistently during the past bear markets, and the fact that Don and my money, along with my 92-year-old mother, family, all of our friends and family, right, are in the exact same portfolios. His conflict at Vanguard or Fidelity are frighteningly worse, even though they are a discount brokerage firm, which is laughable. So where is the real conflict of interest? With a fee-based advisor with the exact same portfolio as you, or a broker with a pie chart or us, where your money is spread across all of their real clients, the muni bond, the tech stock, the emerging market, all that stuff. Okay? Now, anyhow, I wanted to go over that, and I do need to apologize. I need to look into this next. I'm going to put it off again. STRF and STRG. The guy asked me about the 10% on Bitcoin and stuff, and I told him I was going to look at the ratio and backing. I did not have time to check on that again. Again, yield equals risk, and it's just like price equals truth. So the question is, do you want to be capped on something like Bitcoin? That's like doing a covered call on a growth stock. Yeah, you make the 7-8%, but the stock went up 20 or 25. So sometimes you don't really want to cap your upside. And with something like Bitcoin, do you want the upside or not? Anyway, I'll try to get back to that. Not that we're off next week, but the following week. Now, the last mailbag, and this was kind of said over like back Twitter chat with some of our traders that we're close to. And this is from a trader that's very close to Revere for years. And it said, from a trader close to Revere, one of my biggest breakthroughs this year is using SPX as a base for my major portfolio and family account. After years of watching Don, I gave in this January. And now he's rocking it. So me, Don Quixote, AKA Yoda Don. Do or do not, based on price. There is no try. I need to do that in my Yoda voice. Do or do not, based on price. There is no try. We're going to have Don do that when he comes back on the show in 2 weeks. Let him do his Yoda voice, see if he's any better. Anyway, this is what separates Don from virtually all traders, including a lot of CanSlim traders. Look, investing is very hard. So you need to look at your own, if you're your own advisor, you need to look at yourself and manage, because just the difference of 2 or 3 or 4% annualized over years is tens, hundreds of thousands of dollars. It's not just 5 or 10 you're leaving on the table. So look at your advisor, see what they're doing. And if it's you, look at you and then look at us. That's all I'm saying. Anyway, investing is very hard. But my personal favorite for Don, my personal favorite, kind of because I thought of it, is Obi-Don Kenobi. Obi-Don Kenobi, the master. Anyway, if you've got any thoughts on a good handle for Don, a good nickname for Don, please email me your favorite. You can just send it to me directly, dan@revereasset.com. Anyway, so I ask you one last time, are you a clickbait trader? Or do you have rules? And do you follow those rules? So if you're a clickbait trader, Don the Don has an offer you can't refuse. Anyway, Don is off this week. He's on vacation where he's still watching the markets. He just can't help it. He's a junkie, but he's watching from afar and still sending us texts. Look at this, watch this. Anyway, so we're going to go to the younglings now. Think Luke, right? We're going to go to the younglings, the young Jedis, and these guys are rocking it too, to see what is going on in the markets, what is dirty volume, what buying pieces or not. First, Connor's going to do just kind of a market overview, and then we'll dive into a couple of those topics quick, and then Ted and Todd are going to come on. So with that, Connor, take it away.
Yep. For, price is truth, and, we are certainly in a bull market right now. It's been quite a strong week for the markets across the board. The NASDAQ logged 2 back-to-back all-time highs, and the S&P is on track to close at all-time highs as well today. And if we just kind of talk through about what happened this week, is we started Monday morning. We are gapping down over the weekend, and that was just due to some escalation between Israel and Iran, and that, the market was reacting negatively to that, but we bounced right off the 21 EMA and we closed high a day on Monday. And then we've been talking about this 7-8 day range on the S&P 500, and we are looking for a breakout through that. And on Tuesday, we had another positive catalyst with the news that Iran and Israel, there was a ceasefire. And as we know, war is typically bullish for the markets. You might get some short-term fluctuation, volatility, but typically the market tends to go higher. It liked that ceasefire news, we gapped up. And then Wednesday, we put in a tight inside day. And Thursday and Friday, we're just falling through to the upside. And I'll bring up a chart of the NASDAQ composite as well. And you can see 4 days up in a row into all-time highs. And again, if you're bearish right now, you just have to ask yourself, because your process is very flawed. Price has guided us the whole way. We're still on that power trend, which started. We're still, continuing higher from those follow through days in April. And then we also, another thing that we pay close attention to is, sentiment exposure. And yesterday we got the NAM exposure index numbers. We talked about that in the video yesterday as well. And it's pretty crazy that that reading came in at 81 and the market's at all-time highs. So basically what that means is a lot of people still don't believe the rally. They might be scared to get into the market when the market is just acting extremely bullish. I'll bring up a chart of NVIDIA. This is held in protection as well. This is making new all-time highs. And in the past 10 weeks, NVIDIA has added 1.7 trillion in market cap off the lows. And again, very hard to be bearish when you have the leader in AI in semiconductors making new highs. And the market tends to do its best work when semiconductors are in an uptrend, and NVIDIA is making new highs today. That's very bullish. But there has been a little bit of volatility in other stocks as well. NVIS, we own this one as well. This one had a shakeout day on Thursday, and then this one's rallying back up quite nicely. And then again, some other holdings at Revere, GEV, this one's making new highs as well today. Trump announced that they continue to plan on, investing more money in AI for these power companies. And when you see leaders continue to make new highs, there is absolutely no reason to be bearish. We'll take a look at the VIX as well. This is another thing that we look at. This is just the volatility index. Again, this is below 18, and that's the best periods to be invested in the market because you're going to see low volatility. And then the ATR, the S&P 500, is only 1.05% right now. So that's why we're seeing that smooth trend on the indexes while individual stocks are outperforming. And on the topic of semiconductors, I'll bring a chart of SMH up as well. And you can see, again, the semiconductor index is making new highs, seeing broad participation across so many different sectors. Sentiment still remains semi-bearish for the markets being at all-time highs. And that's about it. We're just going to ride the trend until it bends. And for now, the trend is up.
And by the way, you're talking about, if you're bearish, you're on the wrong side of it. The market is not. And by the way, we're not bearish or bullish. We're reading the tea leaves, and the market is telling us it's bullish right now. So we're bullish because the market is bullish. If the market turns bearish, we'll be bearish. But he was saying if you're worried about being bearish, folks, if you've got sell rules, it makes it a lot easier to get in. You don't have to worry about getting shellacked next week. Because if the market starts to roll over, we will organically be taken out at mathematical levels at each one of these. Every stock in our portfolio has a stop loss, its own unique specific stop loss based on its ATR and average true range. And also our total portfolio, Revere estimated balance at risk, the whole portfolio, if the whole market has a major sell-off, we know what our estimated loss is for the day. We've got this, it's very, very mathematical with probabilities. Anyway, all right, Connor, now, do you want to explain the dirty volume? Or would one of you like to, who wants to, it doesn't matter, but I wanted to explain that dirty, the distribution days with IBD, right? And why it's a little bit harder now to count the when Bill O'Neill was doing it and doing the distribution days. And by the way, Lowry's is the oldest technical place on the planet, and they came up with the 90% up and down volume days. It's kind of similar to that, but the volume metrics have changed over time. So go ahead.
Yeah. Tracking volume on the indexes is much different than individual stocks. And, there's a couple reasons for that. But again, it's just hard to analyze the volume on the indexes. And that's why the distribution days don't have as much of an edge as they did when William O'Neill created that. And when we're buying stocks, we want to see big volume breaking out. But one thing that people don't sometimes realize is that when the indexes are trending up in an uptrend, low volume is fine. You can see all these days below average volume, just trending up the right side. Volume is the most useful on turning points and capitulation on the indexes. See right here, this is when we bottomed in April, and you can see huge volume. And so I've just found that, just using price action, moving averages, technical analysis on the indexes is more useful than trying to analyze the volume.
And right there, what you just showed, that example right there is exactly why. You've got 3 distribution days in a row, right? That's daily or is that weekly? Anyway, you've got...
That's daily.
Okay, so you got 3 distribution days. Hell, you got 4 right there, I think. 4 heavy distribution days in a row. So you'd be freaking out and selling, and that actually was calling the bottom. It was capitulation. So sometimes that's counterintuitive. It can actually almost be a contraindicator. I hate to tell you that, but that's why the volume. And by the way, one of the other things that volume has got mixed up is back in the 60s and 70s, there weren't nearly as many products. In 80, when William O'Neill was doing a lot of this stuff and counting the days, you had more individual stocks. You did have a lot of mutual funds, but they were sold at the end of the day and the net asset value. And it just now you got this whole plethora of ETFs and whatever, and they're buying these packaged products. In fact, a lot of the companies on the exchanges are actually packaged products. They're not actually operating companies. So a lot of the ratios, a lot of the stuff has changed. That's the problem. So you got it. That's why price and volume just is a better indicator. All right, that was awesome, Connor. Who's up next, Ted?
Yep, we'll go to Ted.
Alrighty. Yep. So with following Connor, with the S&P coming out of a 5-month base, 6-month base, and the NASDAQ coming out of a 5-month base, and NVIDIA coming out of a 10-month base, I just wanted to review 3 big bases that we are eyeing as a firm as well. And I'm pretty much back with Bitcoin again as the first one. You can go on IBIT, go on the weekly chart. I mean, this is just a typical cup with handle with what we have shared before, the VCP characteristics. From the left side of the base to the right, you just see volatility contraction. And that's precisely what we want to see in constructive price action. And since Bitcoin is nearly 100% driven by supply and demand, since there's really no fundamentals, that's exactly why it's perfect to do technical analysis on Bitcoin. So what we have here now is a weekly flag. If you go on a daily chart, Connor, we also have a daily flag. And you can see that downtrend line. We found support the 50-day moving average, and we're getting extremely tight here. Then we go on an hourly chart. We also have an hourly flag. And really, back last 2024, when I was sharing the Bitcoin setup, for some reason, Bitcoin just loves building fractals on all time frames before it triggers a breakout. And this one just looks amazing. And there's more regulatory clarity coming in the crypto space, with the House and Senate looking to vote on stable coins in the next few weeks. And this is the first pro-crypto president as well, and pro-crypto SEC chair. So Bitcoin is definitely a base that we're extremely bullish on. We own this in Turbo. We have a full size now, and we're pretty hopeful for the future of Bitcoin, looking for the next 3 to 6 months.
Man, look at that moving average stack. Look at that moving average stack on those short-term moving averages, and how they're slightly hooking. Put your cursor there so they can see that, Ted. They're slightly hooking up. That means short-term momentum is starting to increase.
And then, as you can see, and going off your point, Dan, short-term is stacked, and that's above the medium-term 50-day, which is rising, and above the long-term 200-day, which is rising. And if you go on a weekly chart, I'm pretty sure all the moving averages are aligned and rising as well. So you have that full bullish alignment. Yep, you have the 10-week that caught up the price. So there's no big price gap between price and moving averages. The 20 is above the 30, and the 30 is above the 40. So this has all the characteristics that we look for in a breakout that can lead to a clean trend and perhaps a big move as well. So picking back off Bitcoin, in the crypto space, one of the main players is Coinbase. That is the largest US regulated exchange. And this one made a huge move out of that lower flag, lower handle. We can call it a cheat if you want. And this was on the heels of just stablecoin regulatory clarity. And it kind of made a move up with Circle, which is a new recent IPO that was priced at $31 a share and hit 300. So pretty much 10x in a few weeks. And why Coinbase moved off Circle is because Circle is the parent company of USDC, which is the main stable coin in the world. And Coinbase has a deal with them by offering USDC to its customers. It receives about like 50% of the interest generated by USDC from Circle. So that is why Coinbase has shown extreme volume, a big move up. And right now it's just hovering right at those 2021 highs. If you go on a weekly chart, Connor actually bought some for Turbo today off the 5-day moving average, which isn't on the chart right now, and it's retesting that previous high. We just got a starter in there. We do see we are really bullish this name as well, and looking to build into this name. So hopefully we get a more established handle, and then we can put on some more size with this one. So one big catalyst coming up is the House vote in 2 weeks. So we are definitely paying attention to that as well.
Yeah.
The third one is Uber. And I did a podcast a while ago on the fundamentals of Uber as well. And we were extremely bullish, buying it down in the 70s area. And really it did nothing for like a month or so. And the relative strength line started just lagging the S&P 500. It wasn't keeping up with it. And what's funny is sometimes when you decide to let go of position, some news catalyst comes out, and you can point that out. They partnered with Waymo, I think in Atlanta, for the autonomous driving fleet, and it gapped up 10% the next day. So just have to dust it off mentally. But if it sets up again, it's an independent trade. We have to forget the past trade, focus on the present one that's potentially setting up, which it is. And we'll just have to buy it back, even though it's higher.
And hang on a second. What Ted just said is actually a professional, seasoned portfolio manager or hedge fund manager that bought based on price and volume, bought based on a setup, followed his rules because it broke down, because you didn't know it was going to gap up 10% the next day. Hell, it could have gapped down another 10 or another 20. You got to follow your rules. Here's the hard part. Everybody can do that part. Well, not everybody. A lot of people can do that part and at least try to follow their stop. What they can't do is get back in. They go, God, I lost money on that stock. And they won't get back in. And especially if it happened a couple times in a row. If you get a couple small losses in a row, you go, oh, I'm no good at that stock. Nonsense. If that stock is setting up again and it's one of the top best 8 stocks or 10 based on relative strength and all the metrics you're using, you got to be able to take that same position again. That's what professionals do. What about you? What about your manager? When you lose money on a stock, are you able to get back into it, or you just pass and move along? Again, are you a clickbait trader? All right, Ted, go ahead.
Yep. So just to finish off the technicals of Uber, Connor has the monthly chart. Beautiful, really IPO base, high monthly handle. That's like what, a year base on top of the base before, and we're really just breaking out of that. So the technicals are looking beautiful here, and fundamentally, the new CEO Dara, when he came in, has really turned this company around from a company that loses money and bleeds money to a free cash flow machine now. You can see the earnings in the bottom of the chart. Triple-digit earnings. They're accelerating in sales. Institutions, funds are accumulating this name. And not only that, they do have an N of CanSlim as well, which is heading into the autonomous vehicle spaces, partnering up with AV companies like Waymo, like some other ones in Europe. And in my opinion, they will be a dominant player in the space, despite what Tesla is doing over there with their robo-taxis as well. So
Tesla
Uber has the
helped
market
them the
share.
last couple of days.
Yeah. And what's most important is
when you sent me the thing saying that they're going to do, you guys sent me the thing on the thing on our text feed that they were going to roll out their Tesla was going to roll out their test drivers in Austin, like the test cars with autonomous driving. And so I sent my son Logan lives in Austin. I said, hey, go test these out. Let me know how well they work and stuff. And he said, yeah, I'm not going to be the first guinea pig. I think I'll wait to be at least number 3 or 4. And then then next day when it opened up, that very first car had a little bit of problem. So he was right to do that. But here's the thing that Ted's talking about, though. On Uber, he believes it's going to be the leader, and he believes it is setting up right now. But Price will have to continue to confirm his hypothesis, his N in CanSlim, or he will not hold it through a big drawdown. Go ahead, Ted.
Yeah, just finally, what Uber has right now that Tesla doesn't, and maybe Tesla will surpass them in the future. We don't know right now, and there's no evidence of that, is the market share. They have about 75% of the U.S. market share in ride hailing, and then 26% of the global market share. And then even more important than that is just the mind share. When you think of a taxi now, when you think of calling a ride that's not your own car, you think of Uber.
Yep.
And Uber at the end of the day is a verb. And when a company becomes a verb, most of the times it heads to the trillion market cap territory.
Wow.
So
when a company, say that again, when a company becomes a verb, it's headed to a trillion. Ted, that is a gold nugget.
Yeah.
Huh?
Look at Google, look at Amazon, all these companies.
Nope,
all the big ones are verbs.
And that's like Q-tip. Remember, they're actually ear swabs or cotton swab, whatever you call them. Q-tip became so popular and so dominant, everybody calls them Q-tips now. And that's actually the brand name. All right, Ted, that was awesome. So now we've got Todd coming up, and Todd, you're going to talk about the Golden Cross.
Right, the Golden Cross has occurred on the NASDAQ 100, and today we're going to talk about the QQQs, which is the ETF that represents the NASDAQ 100. Also, the QQQ equal weight had a Golden Cross on the 24th of June as well. And if you guys remember from back in April, I did the stats on the Death Cross, and the Death Cross is the opposite of the Golden Cross, where the Golden Cross is where the 50-day crosses through the 200-day to the upside. The Death Cross is where the 50-day crosses below the 200-day on the downside.
Slices, but yeah.
So in this particular case, the Golden Cross has much more predictive value than the Death Cross did. And I just want to summarize that over the long term, the Death Cross was only accurate since 2000, 25% in 25% of the instances.
So the Death Cross, hang on. So the Death Cross is worthless, and it's clickbait to scare the crap out of investors. That's what the Death Cross is. So next time you hear Death Cross, think clickbait. What is price and volume telling me? All right, go ahead, Todd.
Yeah, you really should be looking more to buy on the Death Cross unless we're going to enter a severe bear market.
Right.
In terms of the Golden Cross, again, this is not a big indicator for us by any means. It's not a tertiary indicator for us. It's not a quarterary indicator for us. We don't even look at this, but it's just a big item in the news right now. And I got this particular slide here from Jack Trades 992 on X.
Mm-hmm.
And he was nice enough to go through this data, and I confirm these dates are accurate. And what this shows is the QQQs after a Golden Cross, and it had to be the first occurrence in a 12-month period. So it did that to take out some of the chop, because there's a couple periods where we vacillate above and below a couple times.
Right, it's got to be the first break.
Yeah, this has got to be the first break that's occurred in 12 months. And it goes on to show a week, 2 weeks, 3 weeks, on out to a year later. And boy, you can see when this occurs, you've got majorly positive results that go out in every single category out to a year. And then a year later, 100% of the time, we were up. And sometimes big. In a couple of years, single digits to not even a digit. But overall, that very last column is showing that a year out, it's been very accurate.
So here's a question. Hang on. So here's a question I have for the listener. Didn't mean to interrupt, but here's a question I have for the listener. Because if you're clickbait and you're worried about all the news and you're getting all freaked out, whether it's tariffs or Israel, Iran, or whatever it is, right? And all-time highs. Market's all-time highs. Oh my God, we got to sell. But the market's probably wanting to move higher. Bill O'Neill used to always say, you want to buy high and sell higher, right? So this is the Golden Cross is pretty high probabilities that the market's setting up to be higher in the next 6 months to a year, even 3 months, except for one time, right? So your fears are not lining up with the probabilities. Now, the probabilities, what Todd's saying is the probabilities aren't enough. We got to see that price and volume and leading stocks and all this other stuff, that they're actually going up, and they are. The market's very strong right now. Price is confirming this Golden Cross at the moment. If it's not, we got stops. Do you? All right, Todd.
All right. Yep. And that's our primary indicator, price. And if price is confirming, that's all we care about. It's confirming in the leadership. It's confirming on the indexes. And now we got the mid cap and small caps above the 200-day. But anyhow, let's just go through a couple slides to show a few periods of what this looked like. This is the current Golden Cross that you can see. It just occurred on the 24th, and the Qs are at all-time highs right now. Connor, if you could go to the next slide. And in this particular case, this was the 3/13 of 23 Golden Cross, which came out of the 2022 bear market. And although we weren't at all-time highs like we are now, we were still kind of off the pre-COVID highs at this point,
Yep.
or the post-COVID highs. We went on to make a 73% run after this golden cross occurred from the low, or from the close of the golden cross day to the peak in the upper right-hand corner. So let's go to the next slide and we'll show you COVID. This was barely a black cross or a death cross and a golden cross. You can see in the lower left-hand corner how we just basically crossed below the 200-day and then went back above. But we went on to make a 78% gain into the peaks in this example. And incidentally, this was an example where we were making 52-week highs,
Yep.
breaking through this.
Yep.
And let's go through one or two more examples real quick. This was a choppy period from the 11/17/2015 Golden Cross, and you can see kind of like we vacillated up and down through it. But that one kind of right in the middle where I marked it with a gray conical, that
Right.
was the Golden Cross. Yeah, two more back, Connor. If you just go, right there. That was this particular Golden Cross that didn't really. It did go on and work a year out, but you can see that was a very choppy period. And then finally, I want to go back to another example of where we were at all-time highs, and this was the 11/9/2005 Golden Cross. And in this case, we were basically making new highs out of this 2005 one, and then we went in several weeks to make higher highs, but then that segued into like the financial crisis chop period
Right.
after that.
Right.
So that's it, and those are just some examples, and this can be extremely bullish. Just
Yeah.
another indicator.
Yeah, absolutely. And by the way, the Wall Street sometimes listens to this, so it can have a self-fulfilling prophecy. So the news can actually sometimes affect price. A lot of times they will write the article to backfill, like, oh, the market went up yesterday. Let's find a story to figure out why that is. And they'll try to backfill that data, right? But the first two golden crosses he showed you were strong primary uptrends. It kind of just went pretty much up, and we were a big part of that, and we just kind of participate along. Those last two were choppier. You would have traded in and out a little bit more of those because they did have bigger drawdowns, but you still would have a decent equity curve. You don't have to have the massive drawdowns, okay? There's a way to make money when the market, you got to know when to put the gas on, when to accelerate, and when to take more risk because the risk profile of the markets is lower. I don't mind taking risk. I just want to be overcompensated for the risk I take. If it's 50-50, hell, I'm out. I can do that playing blackjack in Vegas, almost 49-51, whatever, right? But I want the odds stacked in my favor. If they're not stacked in my favor, there's too many times making money is easy. That you don't have to do it where it's really choppy times. You can have a sell discipline and smooth it out a little bit. You don't have to make 7-8% with 35% drawdowns every 5, 6, 7 years. There's a better way to do it where you can go down 10, 12, maybe 14%, not 35 or 40. And you can make good, solid, high single-digit, low double-digit returns. We've been doing that consistently. It is a bet, and all of our money is in these portfolios. Don and I, the team, we're all in. We're not the guy on CNBC saying, this stock is the greatest thing since sliced bread. I don't own it. My wife doesn't own it. My company doesn't own it. You should. That's because you're the cattle. He's the cowboy. He's the roper. He's delivering you to market. You're the diversifier. You're the widget in his pie charts or us portfolio. He takes your money, spreads it out across all of his clients, muni bond, tech stock, treasury bonds, and spreads it among those places. He's not looking to buy and sell and looking to buy and sell and actively manage and do your risk. They do it with a pie chart and say all these different diversification will help you during a market crisis. Not true. And all the correlations go together, grow together, and it all goes down together, albeit at different rates. But still, I'd rather have a sell discipline where I can hedge or move to cash and then have a heavier equity position when the coast is clear. Listen, if you want to find out more, like I said, there's a contact us button on our website. And right next to that is our subscribe button. You can just put your name and email address in. This podcast will go right to you Saturday morning. It's Friday. We record this Friday at 10:30 Central Time, and Zach will normally have it out on YouTube by 1 or 2. So if you go to YouTube and just type in Revere Asset and hit subscribe, the stock nerds get it before the market close on Friday. They'll get it before the close today, and they'll be able to go make some adjustments maybe. So there's 2 ways to get our stuff, and we also archive everything on our website going back years. So if you want to hear what we were saying right before COVID or any 2022, whatever, any time period, you can go back and listen. We don't edit it or archive it out. I want to remind everybody we're off this next July 4th. We're at Revere. The reason we named our company Revere was after kind of Paul Revere, because we liked the warning. He warned the British were coming. We warn people against danger in market duress, in portfolio when times are dangerous. We're making market-like returns with less risk, not more risk. You've always been told to make more money, you got to take more risk. Not at Revere. Anyway, folks, have a wonderful and safe July 4th weekend. And again, just go to our website and hit the subscribe button, or you can always call us old school at 855-REAL-WEALTH. So we can help you and make your money look just like our money. We'll talk to you next week on Your Money. Because it's not how much you make in the market, it's how much you can keep.